Okay, good morning, everybody. Welcome to this week's webinar on sentiment analysis in the Forex market. Now, just a little bit about myself. My name is Greg Firman. I've worked in the futures and Forex markets for the last 10 years, and in 2006 founded eTradeFX. I am Series 3 and Series 4 commodity futures license and retail Forex license, and registered with the Commodity Futures Trading Commission and the National Futures Association as a commodity trade advisor. I've worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading while providing very specific risk management models with preservation of capital the primary focus. Now, I have further worked as a market analyst for TraderPlanet.com since 2008, a prominent free social media website that globally connects traders, where I provide daily commentary to a large number of followers in the Forex, futures, and stock markets. Now, looking at today's webinar, we are going to be looking at a few specific things, a number of which things we've covered in the past. We're going to go over it again. Price action based on analysis without applying complex fundamentals that often confuse the average trader. A review of the major pairs and what to expect for the remainder of March. Intermarket correlations that are driving certain Forex pairs and the market in general. Things that you should be watching for. And basic indicators to clearly identify market sentiment and how to trade these regardless of market conditions. And this is going to be a critical one. Now, what we're going to do is we're going to begin where we always do with the US dollar index. Now, the one thing I want to point out here with the US dollar index is that most people do not have access to this chart. Now, there's several brokers that have they've made their own Forex or their own dollar index, which is not really accurate because they're involving currencies that are not actually in the real DXY, which is the symbol of the dollar index. So when we look at this right now, you can see that I'm using the Windsor Broker demo. Now, to clarify, I do not work for Windsor Broker. I have no affiliation with them whatsoever. As I've talked about in past webinars, I do, however, run demo accounts here for doing analysis because the futures charts can be very, very expensive to have live moving charts. Now, the beauty of Europe is, and Canada and Australia and most of the rest of the world, other than the U.S., we trade CFDs. Most of us don't even trade futures. We trade contracts for difference, which is a far better vehicle in my respectful opinion because you can control the position size. So when we look at this, the Windsor Broker on their standard demo account allows free access to the US dollar index. It allows it to the S&P 500, gold, oil, natural gas, a number of stocks, all of which are correlated to Forex pairs that the average trader doesn't realize. So when we look at the US dollar index, we've had a very, very active morning here. So when we look at price-based analysis without applying to any real degree what's going on here, what I want to point out is these two large red candles. Now, the key thing that I want to point out is this is very much like a movie playing out. And guys, we've seen this movie before. We saw the exact same movie last Thursday. Okay, last week we had the Fed Yellen, who was talking didn't really change any of her rhetoric in her statement. Maybe just hinted that they're focused a little bit more on the data now than what they were before, but the rest of the statement is the same. So this brings me to this morning with the ECB, and this is something that I find when we look about short-term sentiment is that they feel that this is bullish for the euro and it's bearish for the US dollar. And they're taking very aggressive positions prior to the real announcement, which is tomorrow. So what I've advised my own direct clients is that we're actually not even trading during this. And I'm going to explain that more on Euro-US when I go over to that pair in a minute. But the first thing I want to point out is that, again, we've seen this before. We've had these big spikes and then a complete and utter reversal for the next 2, 3, 4 days. So here we are, Thursday, end of the week. We have thin, illiquid markets. Most people are adjusting positions prior to the non-farm payroll. Real money never trades the news. Real money avoids the news like the plague, because what happens during these announcements is that you have these wild price swings that they whipsaw you out on both sides. So it's best to trade, sit out during these announcements, let them fight it out, and then move back in after the fact. So what I want to do is, when I look at this type of a setup, there are some key things that are a little bit different this week. We can see here that this candle is pushing below trendline support. Now, when we look at sentiment and we look at when we look at basic indicators to clearly identify the sentiment, we're pushing through a demand line. So basically, this trend line here that's drawn in here is your supply line. We again have that's our demand line, and then we have our supply line that comes in here. So if we push through the demand line, then the basic consensus based on sentiment is that there is very little demand for the U.S. dollars against a basket of currency, that basket being euro, basically a 95% correlation. The U.S. dollar index makes up 60-some-odd% of the dollar index, so it's heavily trade weighted to the euro. So right now, if we lose this key demand line, then that would tell me that there's very little demand for U.S. dollars at the current time, and maybe on a longer period, it could continue. So what we want to watch is we want to watch this area very closely. Now, the problem with trading around an area like this, when you identify a absolutely critical support level on a daily, longer time frame, because I guarantee you, your big money traders are not trading on the 1 hour. Some are trading on the 1 hour, but they're not trading on the 5 minute, the 1 minute, the 15 minute. Big money can't afford to trade down there because there's just too much back and forth swings, too many false signals. We want to avoid those lower time frames. So real money is watching this area very closely on the U.S. dollar index as to what the outcome of this, and more importantly, what the open of tomorrow's candle is going to be. If it opens below this trend line, below this demand line, then that would tell me that at the present time going forward, there's going to be very little demand for the U.S. dollar. But the problem here is that if we get a good non-farm payroll number, all the gains, all the losses that the U.S. dollar made today can be completely erased in a blink of an eye. That is going in and trying to trade something like that, guys. That's gambling. That's not trading. Trading the news is gambling. So we don't want that. That's exactly what we're not looking for. We're looking for steady, day-to-day transactions based on supply and demand, not wild swings that are causing these erratic price movements. Because there's no way that, like, again, when we look at this big move last Thursday based on a weaker GDP number on the U.S., I'll give it that. It was a weaker U.S. number, but it didn't matter. They stepped back in and started buying dollars like crazy. After the announcement of the GDP and Fed's yelling, basically you could read any website out there saying the euro's going to 140, it's going to 141. Within a matter of hours, the euro was slipped back down inside of its current range, completely wiping out any gains it made, leaving everybody that bought up high stopped out. Now, this week, we're back up again. So we're going to talk about that more in a minute. But the main thing is we want to identify that we have absolutely critical support. And we have two very basic indicators here, guys, that can identify that for you. And that's this Donchian band that runs along here and this trend line support. So how do we draw that trend line in? I've talked about this before. We look for a low point. To create a demand line, we've got that low point. We want two candles to the left, two candles to the right. Higher than that low point, we then have a makeshift short-term, maybe medium or long-term demand line. So you can see we bounce off of that. But then what I want to point out here is what I've talked about in previous webinars. We can stack in very simple moving averages. The problem, in my respectful opinion, why moving averages get a bad name is because everybody is using them for a crossover. When using it for a pivot point is what will make not only make you money, but it will help you identify sentiment. So right now, this is just a standard 6-day exponential moving average. You can use a standard, you can use a simple. There's not that big of a difference, guys, between them. A little bit, a smooth or a weighted, there can be a bit of a difference into a lower time frame. But we can see that the market retraced back up to this 6-day, tagged it, and then continued down. Now, I often hear voodoo things like Fibonacci and Elliott waves and things like this. I don't even have them on my chart. Fibonacci, again, a guy from the 16th century, a goat herder that may or may not have been a mathematician. We think he was. But the 16th century and the 21st century, there's a big gap there. So moving averages are designed for trading. Fibonacci is not. So again, I always reinforce that don't be fooled by Fibonacci analysis, because it's not, in my respectful opinion, worth much. 61.8 is a number worth looking at, but you can accomplish the same thing, guys, and have it moving. Instead of a locked-in retracement area, you can use a simple moving average like this to tell you. So when we break above, if we can break above this area at 80.14, it will likely be tomorrow. That's what it will likely be. And if it does, we look for how the next candle opens above that. But you can see then we have our supply line. We have additional moving averages tacked in up here. 25-day EMA, the center Donchian band, an absolutely critical level. Okay. And then the 100-day, they're all stacked in here. It doesn't look great for the dollar. But if the dollar is going to reverse, it first has to hold above this trend line. Okay, we don't want it to open this next candle tomorrow to open below this trend line. We want it to open back up inside this trend line. I personally believe it will, because the same people that are trying to scalp out the euro right now by selling dollars, they're going to take profit. If they're smart, they're going to take profit, and that's going to indirectly push the dollar back up. We then have to overtake this first level to tell us, okay, look, we can start to get long here again on the dollar. Not to say that that's going to happen. So we also want to look at our monthly cycles briefly before I go into the pairs. Very, very important when we look at this. So what is the likely outcome for March in the dollar? Well, in most years past, the dollar has had significant rallies. And what I've talked about in previous webinars, in the latter part of February, March, April, May, June, that's when the dollar makes the bulk of its gains. So we're looking for a non-farm payroll number tomorrow, but we want to trade it on Monday or Tuesday. I know that what I said just probably didn't make a whole lot of sense, but guys, when you think about it, it does. Let the scalpers, the news traders, the guys that aren't making money, let them deal with it on Friday. Then next week we have a game plan where we can go into this and say, okay, is the dollar above this trend line on the daily? If it is, and it gets back inside there, we get a non-farm payroll number for tomorrow that's, say, above 150, 160, maybe a slight revision up, then the dollar's going to go screaming higher. That's likely what's going to happen. Now, it is data dependent tomorrow. So when something is data dependent, then you stand aside, because that's not based on sentiment. That's based on gamblers that are looking to try and benefit from that on a very short-term basis. But like I tell my own direct clients, in most cases, whatever that non-farm payroll number is, it doesn't matter. On the Monday or Tuesday of the next week, it usually does the exact opposite, unless there's really something significant about that. So most of the year, we have back and forth trading, back and forth. It's nothing goes straight up, nothing goes straight down. Excuse me. Now, what we want to do is make sure we understand this 80-20 level, this white line that I've drawn across here. This is a critical level that I've talked about. This is basically where the dollar started. This is where the dollar was last year at this time in 2013. So we're within a few pips of that area. So it's not like the dollar is in this big bearish mode like some of these people are talking about. That's just not the case. We're actually trapped between a critical yearly seasonal pattern and a trend line, demand line, or support line. This is a big, big level. Is the dollar overall picture on the dollar bearish? Of course it is. Yes, but the dollar is not just going to collapse. It's going to go up. It's going to go down. All these things are going to happen. So remember, for next week, after that non-farm payroll number, your focus is around these support levels. On the dollar index, 79, 71, we want to see how the market closes. If it closes below it for tomorrow, what Monday is your focus. Focus on what happens on Monday. That is what matters. The non-farm payroll number, guys, just like what the ECB said today, it doesn't matter. The market is going to have a knee-jerk reaction for a day or two, and then just like I pointed out on the dollar index, it just turns around and goes the other way. The ADP report has come out. The ADP report has said that it is very bearish on that non-farm payroll number tomorrow. So if I traded my career off the ADP report, I wouldn't have a nickel to my name. That's the fact. So my bias would be for a better non-farm payroll number because of that ADP report. And again, we want to watch the sentiment on some of the pairs. And one of the pairs I'm going to talk about in a few minutes is dollar yen. It is a leading indicator for what that non-farm payroll number is. But I'll talk about that in a minute. Let's get into some of the pairs here. Make sure we stay within I stay within my allotted time. So because I've done the dollar index, we've looked at that, spent a few minutes. Euro US, guys. Let's look closer at this. First thing we want to do is we want to come to this daily time frame. The dailies are what we're dealing with on a month-to-month basis. Most of your calculations are on a daily basis or a 30-day period. So let's see what we've got going on here. So here's that movie that I talked about that we've seen before. Just looking at things. Can I listen to the host speaking? Can we start now? What's wrong with goats? Tim, that's funny. Yep, you're right. There's nothing wrong with goats, especially if you're eating them. Now, when we look at the dailies on the Euro US, let's have a close look at this. Let's start in the longer time frames and kind of work backwards on this so we get a better understanding. Now, when we look at this movie that I talked about on the dollar index, we can see here's that movie playing out again on the Thursday. This was last Thursday, the same candle right here and right here, okay? They went the exact same thing, and then we can see what actually happened. We then turned around and reversed. But the one thing I want to point out here is, again, what I'm going to talk about is how a simple moving average, not a moving average crossover, just a moving average sitting there, that most people will say moving averages are lagging, they're this, they're that, but why is it that almost every analyst uses them? Every bank trader, every hedge fund manager that I've worked with, they use them. So we can't dispute that, okay? So when we look at this, we can see we've had this big spike up, we've had a retracement back down, and we're just hovering around this 6-day moving average on the Euro US on the dailies. But we have a trend line resistance sitting right here at 138.20. So we're breaking above that. But again, every one of these candles, these huge candles that happen on a single day, there is never been any, very seldom, I'm not never say never, there's very seldomly any significant follow-through, especially when you're leading into a big announcement like the non-farm payroll. If I were to guess at this, I would say that Draghi and Yellen are kind of talking to each other. That's what I would suggest, and that Draghi's going to push it up in anticipation for a big fall. Now, that is simply speculation. But remember, trading is speculation. And what I want to point out with last week is this big spike up here. All of the gains were made prior to the GDP release. After the GDP release, which was horrible, I don't disagree. It's supposed to be 3.2 or 3.4, and it came out at 2.4. That's not a great number, right? So Euro goes screaming higher. But all the gains were made prior to that announcement. That's what's very, very suspicious. They've been caught before releasing this information, saying it was an accident. Clearly, in my respectful opinion, somebody knew that GDP number prior to the announcement. So the same argument could be made here, that it's not really about it's partly about what Draghi said. And I want to be clear, that was not a hawkish statement. That was a dovish statement of Draghi's. Right now it's being interpreted as hawkish. I don't see that at all. Because he didn't say something, it's hawkish. He didn't change his rhetoric. He's not raising rates anytime soon. They're in the same boat as the U.S. So again, the interpretation factor there, maybe the market's getting a little over aggressive here with the euro. Maybe not. We'll see. But for now, again, I don't see that as overly hawkish just because he didn't say something. He could have forgot to say it. And if anybody here is on this webinar and has been trading long enough to deal with the former ECB head, which was Jean-Claude Trichet, I have never seen anybody talk out of both sides of his mouth than this guy. And he will say one thing in the release, and in the press conference, he will say something completely different. Then the very next month, he will turn around and say, I didn't say that. You misinterpreted what I said. You have to be very careful This is why trading around news announcements, like especially around the central banks and the non-farm payroll, very dangerous. And they're not money makers. So when we look at this, we've got a big spike up. You've got partially because of an interpretation that the statement was hawkish and position adjustments ahead of non-farm payroll. Everybody here gets long right now, just like they did last week. They're met with a pretty vicious mauling a couple of days later. So we want to try and avoid bull traps. We want to try and avoid bear traps. And these are the classic things that cause people to lose money. When we look at this in the H4 time frame, we can see here, and the one thing before I go to the H4, I want to point out that what's happening here right now is inconsequential. It should be inconsequential to our trading because the real signal came way, way back here. When we look at this Donchian band forming here, the market has crossed over the 100-day exponential, it's crossed over the 6-day, and it's crossed over the 25-day. And the key level to be buying at is right here. So when this is happening, the big push up, you can see that we've held above this area, natural retracement back down. Again, I don't see that Fibonacci played any part in this whatsoever. I've spent years looking at it, and I've basically removed it from my charts. Other than 61.8, I'll look at. But, if there's people in the audience here today that love Fibonacci, I don't discourage you from using it. If it works for you, then you should keep using it. Absolutely. So when we look at the market moving higher here and the natural retracements, we cross over here, the 6-day right here, but then we come back down and tag this 25-day right to the number. And we can see eventually that area forms a demand line and the euro goes back up and we've managed to stay above this simple 6-day the entire time. If we're looking for a really bearish move on the euro, we're looking for it to not only break the 6, we're looking for it to break the 25. And we also want to break the center Donchian band. Very, very important that center Donchian band, we get below it into the the first and second quadrants. That's what I would call them, 1, 2, 3, and 4. So right now we're in the bullish mode, but how the euro finishes the day tomorrow and how it opens tomorrow is going to probably set the tone a little bit for next week. But again, be careful. We're looking for real price action on the euro. Next Tuesday, all the storm passes. The same reason. If there's a tornado outside, we don't go out and let our kids go out and play in the tornado. We keep them in the house. When the tornado passes, we then let them go in the yard and play. You should take that same approach with trading. It just makes sense. And going in for quick profits, it can be done, but there's we should be careful. So the question is, your take on U.S. CAD. I'm going to come up with U.S. CAD for sure. Should we short Euro U.S. now? No, we should never sell strength. Now, what a lot of people do, and I know the gentleman on the webinar previous to me, he's a great presenter, and I know he was doing a webinar today on why losers add to losers. I missed that webinar. I'm upset I did because I was busy with clients, but that's a great analogy. And what the losers do is they start scaling positions in here, and they add to losers. I assume that's what his webinar was about, but it would make sense. And you don't want to do that. What we want to do is we want to sell this when supply is filled, okay? So when supply is filled, we will get a new trend line up here somewhere. We will stall out, just like you can see right here. You'll have a big candle. Geez, look at that. Just like this one. So you have this little sarcasm there. The big candle up here, and then you can see the next two candles. Basically, that's it. It ran out of steam. And the two candles below this main candle are also lower than this high point. So in this case, we sell the third candle. We could get a little, on this one here, I openly admit I got in a little early and I was selling right here because I just couldn't lay off of it. Because my opinion is much like what of Yellen is my same opinion of Draghi, is that Yellen was not really that dovish and Draghi was not that hawkish. So it's really the same thing, just a different week in a different direction. That's the way you kind of want to look at this and break it down. So when we see this, we're looking for this thing to stall. So we sold this candle right here. No, that's not our high point yet. We have not filled supply yet. We have not filled demand yet. So when we fill demand, we will get a new supply line, and then away we go. So I'm going to keep moving. I want to make sure I get all these things. So that's how we're looking at. And one thing I do want to point out on the longer time frames, that euro is looking bullish. Another reason why I would back off that short right now. And again, we see it on the weekly. There it is, hugging that 6-day right there at 136.79. I'm going to sell 136.79, guys. That's what I'm going to do. But if I get a new supply line up here in the lower time frames, the H4, but I'm not going under H4 when the weekly and the daily look like, or the weekly and the monthly look like that. So the pound dollar, getting into this because I know I want to stay within my 45 minutes, pound dollar, guys. Here we are right here. And the pound dollar, this is basically feeding off of when we talk about intermarket correlations. The intermarket correlation here that I am seeing, that I'm advising my clients, is that if we are trading euro, US, or pound dollar, we need to be incredibly focused on Euro Great Britain and what it's doing. Because Euro Great Britain is a driving factor because of the heavy exchange rate between these two trading partners. The UK, Germany, they are each other's top trading partner now. The U.S. is not. So, but remember that Euro US, Euro Great Britain is a synthetic cross pair. So for it to be traded, we first have to go through Euro US and Great Britain US. So right now, Great Britain US is pinned. And it is pinned mainly because of this Euro strength. So if we have Euro strength, guess what we also have? Big Euro Great Britain strength. There it is. So they have to sell Great Britain US technically to buy Euro Great Britain. And that tells you, basically gives you a very good idea why Great Britain US is, because this is a question I had this morning from my own guys saying, I'm long pound dollar, but this thing is just sitting there doing nothing. It was actually down money. And I said, yeah, but you're not looking over at the driving pair. Today is the Euro's day. So let them have it. Don't try and beat the market here. Join them. If you want to buy euros today, sure, but look for a good place to do it. Maybe on some of the cross pairs. Euro Swiss franc, guys. That's one that I've been pointing to my own guys. It's an easier trade because you've got peg down there at 120. We came down to 121 on Sunday night. Buy the heck out of it and just put your stop at 119.95. I've been long repeatedly Euro Swiss franc between 122 and 124. Never been stopped out on the trade. But if you start going long towards 124, not really recommended either because seems to be a cap going on around 125 also. But the 121, 120, these are big levels. Swiss franc's done a heck of a job holding that peg. Will it hold forever? That's hard to say. But for now, it works until it doesn't work anymore, right? That's what we want to think. That's the way we want to think. So when we look at this right now, Great Britain US potentially could still be a good long right here. We're looking at it on the daily right now. We're tagged right on that trend line resistance right now. Now, when we look at this, I also want to bring in again the trend line. So our trend line support, solid as a rock. 6-day inside that trend line. Ooh, that's bullish too, guys. So when that 6-day slips inside that trend line, we've got a wedge formation here that's been drawn in. This is warning that we're probably going to break to the upside. But if that's going to happen, I'm not convinced that's today. If it's going to happen, it's going to be tomorrow. Like this wedge will break tomorrow. That much I can guarantee you. And it's dependent on the non-farm payroll number. After it does the break, we get a pause on Monday. Tuesday, we start hitting the market. That's what we do, guys. We don't get involved with these news announcements in thin liquid market. Very, very dangerous stuff. So, we want to be cautious of that or just avoid it altogether. Like I haven't had a losing trade all week, guys. Why would I trade today and tomorrow? I just wouldn't. It's irresponsible for me to trade or for me to advise my clients to trade during this kind of nonsense. We have no clue what that number is going to. I have a bit of a clue what that number is tomorrow, but I have a 50-50 chance of being right. I don't like that one bit. So with pound dollar, we look at it in the H4 time frame. You can see what I've been doing all week. I've been selling into this trend line, and I've been buying this demand line. There's demand for this currency at down between 166.16, 166.15, and this 166.60 area. That's my buy zone for the entire week. I'm not really that interested in selling this pair. You can see that we are pushing above the trend line on the longer time frames on the weekly, and on the monthly with the pound dollar, we've taken out the 100-day EMA. We've taken out the trend line resistance. We're above the 100-day EMA. not a great sell. It's a good sell on an intraday basis on when there's heavy volume in there to provide stability. There will be no stability tomorrow morning at 8:30 a.m. Eastern Standard. Trying to trade it, insane. I wouldn't even think about it. So when we look at this, the other thing I want to bring in here is my RSI. You can see that I've got this on an 8 period. I have a 3-line split, 60, 50, 40. If I'm above the 50, the primary market is bullish. If I'm above the 60, there's momentum. This is warning me that there is potentially momentum coming on this trade. The average person that I've seen, most of the things that I've seen being taught, are the RSI is used for overbought and oversold. I don't really look at those conditions per se. I'm looking to buy strength and I'm looking to sell weakness. That's what I want to do. I don't want to constantly go counter trend. That's a problem. Now, when I use the word trend, I use that word loosely because the trend is a funny thing to determine, okay? The markets are technically trending 20% of the time. That's it. So the other 80% of the time, we're playing within areas of supply and demand. Supply and demand are the forces that drive the market. That's it. That's a fact. News traders, scalpers, intraday, short-term traders, they do not drive the market. They make brokers rich. And we don't want to make these brokers rich. We want to trade quality, not quantity. Okay? Very, very important in your trading. So the pound dollar, slightly bullish, but it is dependent on the non-farm payroll tomorrow. Either way, next week, we will have our real price, and then we can trade it. So right now, it does carry a bullish edge, and that's because it's center Donchian band, it's above the 25, it's above the demand line, it's above the 6. So we're looking at that even on a sell-off tomorrow. We're looking for one down around the 166 area, even if it's a great number for the U.S., nothing goes straight up, nothing goes straight down. Just doesn't work that way. U.S. Swiss franc, I'm not going to spend a lot of time on this one, guys, here this morning because it's nothing more than a Euro-U.S. trade. That's what it is. You know, I hate to break the news to everybody, but it's not even a major pair. The major pair, really, in my respectful opinion, is Euro-Swiss franc, okay? Because U.S. Swiss franc is actually the synthetic cross. U.S. Swiss franc is made up of Euro-U.S. and Euro-Swiss franc. That's what U.S. Swiss is, guys. So it's nothing more than 90% of the time, it's just a Euro-U.S. trade. So if Euro-U.S. keeps going up, this one's going down. If Euro-U.S. reverses, U.S. Swiss franc goes up. Nothing more needs to be said on that pair at this time. Dollar yen, something does need to be said here. Now, what I'm going to tell you about dollar yen is its extreme correlation to the non-farm payroll number and to equities. So basically, the dollar yen is affected more by the non-farm payroll number than any other pair. What's been very disconcerting to me over the last several weeks is the fact that the dollar yen, with this apparent huge equity rally, it can't budge off that area, and it actually moved lower. So today, the last couple of days, we finally started moving on this, but it's very unusual that if this equity rally is actually a legitimate rally in the S&P 500, why was the dollar yen moving down? So now a couple of days before the non-farm payroll, all of a sudden money starts pouring into longs. So this reminds me of last week with the GDP report. All of a sudden, the major pairs collapsed 12 hours, 15 hours before the GDP number. So now, all of a sudden, I'm seeing the same thing on dollar yen. So again, guys, that's a bit of a red flag for me, is that in most cases, the dollar yen has made a big move prior to it made a big move during the non-farm payroll too, but the real move was prior to the numbers. So a lot of money here is pouring into buying U.S. dollars against the Japanese yen. That we should take as a warning sign that non-farm payroll number may not be what we think it is. And if we go back to what I said about that ADP report being grossly inaccurate most of the time, then if it's saying it's weaker number, down is up is down, right? But the dollar yen is a warning sign. So the dollar yen did not rally at all. And it didn't rally, and it actually continued to move lower after that GDP release last week, right? So the sentiment is that market is moving lower. That sentiment tells us it tells us a couple of things. What the real money is doing here. Real money right now is pouring into dollar yen. Well, why would they be doing that if we have a bad number tomorrow? That doesn't make sense. The only thing that could make sense is that once again the Fed is interfering with the markets, as he so often does, that they're propping it up, getting ready for a big fall. That's the alternative. So again, we're going in, trading the non-farm payroll number is gambling, right? I'm going to say it again so everybody understands. We don't want to get involved with this type of gambling. I've just laid out the scenario. So everything about the non-farm payroll could be technically derived from what's going on with dollar yen. So right now, that's the scenario. Either they already know the number, and those same guys that were pouring out of U.S. dollars last week are now pouring into dollars because they know that number is going to come out above 150. If they revise those previous months back up, then the argument that this was all weather related is validated. If that argument is validated, forget about it. The dollar's going higher, and that's it. And everybody is caught in a bull trap, a bear trap with the U.S. dollar, So be careful of that. Now, again, going in and looking at your charts and everything else first thing tomorrow morning, don't even waste your time. Just, once you see the number, you get a good feel for what things are going to be for next week. And then next week, we go in and we trade this thing like traders. That's very important, okay? So I'm going to keep moving into these commodity pairs. New Zealand is pushing through. We had a big rundown. It's pushing higher. Very, very bullish. Basically feeding off a lot of that Aussie weakness in the Aussie-New Zealand. The Aussie-New Zealand cross pair is very similar situation to Euro-US and Great Britain-US. The Aussie-New Zealand has a dramatic effect these days, when it never used to, really, a little bit, but more so than anything else. If you're trading Aussie-US or New Zealand-US, the intermarket correlation there and what to watch for is Aussie-New Zealand. So if Aussie-New Zealand takes a big spike up, if you're going long Aussie-US or New Zealand-US and you're trying to make up your mind, always go to Aussie-US. If Aussie-New Zealand is going down, then you buy New Zealand-US. And that's what's happened over the last week or so. Aussie, again, some short-term bad data. I'm going to talk about the Aussie in a minute and why that data meant nothing. And there was a knee-jerk short-term reaction for a few days, a week, and then the buyers come right back in. Let's face it, guys. What do stock traders look for? Hedge fund managers or fund managers in stocks? They look for dividends, right? Aussie-US is a huge dividend payer. If you're holding a long position on Aussie-US, you're getting paid huge swap every single day. A stock trader would be drooling over that kind of dividend, right? So they often hold these stocks year over year, not with a real hoping to make money on the stock, but more importantly, they want that dividend, right? New Zealand US, Aussie US, these are high-yielding currencies. Only in the case of usually global conflict do they collapse. And even in this case, with what's been going on in Russia, they didn't collapse. They went higher. So go figure. And then, they took a little bit of a dip, but ultimately New Zealand kept kind of creeping up there. So they're moving in there. They want the yield. They see the equities moving higher, but there's a high correlation here, guys, to the S&P 500. So if that S&P 500 turns, if that payroll number comes out good tomorrow and it's determined that the Fed is going to actually increase its tapering from maybe $10 billion a month to, say, 15 or 20, this is hugely dollar positive. So we match that with the seasonality. What do we come up with? A dollar rally. So we have to get the number tomorrow, but it's not tomorrow we want to trade. We want to trade on sentiment after the fact, not during. Because, again, that very seldomly worked out. So, and bringing me to the Aussie pair, that is something, and trust me, I know I'm getting a tag there from a message about US CAD. JP, it's coming. It's next on the list. I won't forget about you for sure. The Aussie US. Okay. So when we look at this right now, we're on the daily time frame. We have turned bullish yet again. So again, we're looking at the moving average as triggers. So when we look at this back here, so everybody is really concerned with what's going on right now. But if we look at this simple candle on the daily time frame, okay, so we look at it when we're hugging. We've gone down. We're just tagging that 6 day. And then all of a sudden we get this one here with this big bull move up, and then this candle right here opens well above that. You can see that basically we've moved consistently higher. And on the dailies, if I draw just a quick makeshift line across here, you can see that trade was never really negative. You know, like maybe a week and a half later, it went down a couple of pips, but then it climbed up another 200 pips. So the sentiment here is that, you know, you're looking for a bigger, broader move, and then using those shorter time frames for your entry point. So if we look at this rate here, again, any one of these candles in the 4-hour time frame, this is a fantastic trade. And this was actually a recommended trade on TraderPlanet.com last night that I said, okay, get into this thing long around the 89.50, 89.60. Buy this thing. And I did that ahead of the market because I already saw what was happening here. And then from there, I can make a decision as to what to do. We've crossed over the 100-day EMA, 90.47. Right now, this is bullish. Now, the only thing is I've got a price target here that is a bit concerning at 91. I would suggest that this rally could come to a close around this level, okay? So a potential short could be right there, because when we look at things on the weekly time frame, we're mildly bullish, but you can see we're still well below the 25 and the 100. So the short-term, medium-term trade, which I would call a couple of days to a couple of weeks, then usually the primary trend follows. Now, if we look at it on a monthly time frame, this is where we have a bit of a problem. In this area right here, 89.70, we're coming back out of that. But you can see that when the market crossed back here, I'm going to go back over here and anoint that so everybody can see. Okay, so basically back here, this was the big move right there. So it crossed back here down around this 71 level. This was, you know, this is the monthly time frame. I'm just using this as an example. But when it crossed that, it really shot higher. But you could do the same thing when you look at it from the daily perspective and see that bigger move. But always combine a couple of moving averages. It doesn't always have to be about a moving average crossover. Okay, very important. So U.S.-Canada, this is the one that everybody's a couple of different messages on here. They want to see U.S.-Canada. Okay, so here we go. We've got a few minutes left, so perfect timing. We come into this on the daily. Okay, now on the daily time frame, we've got our supply line. Supply was filled at 111.60. That's basically what's happening here. Okay. We go maybe out a little bit further onto the weekly. We get an even clearer picture here at 112.23. Supply is filled. So basically, if we look at this, shorts are reasonable. But there's a problem right there, 109.42. So the 109.42 is, again, that simple 6-day moving average. I'm not looking for a crossover. I'm not looking for anything. How could something be lagging if it's sitting there? That's like saying 38.2 in Fibonacci is lagging or 61.8 in Fibonacci is lagging. Doesn't make the statement doesn't make sense. This moving average is moving up with the market. It's calculating it. So the theory is the market's above it, we're long. The market's below it, we're short. It's a very simple way of doing things without getting complicated crossovers and everything else. Because a lot of people, they'll say, okay, I use the 15 or the 25 and the 50 moving average crossover. Well, if you use that, it's grossly lagging. If you used, like a 15 and a 50, hugely lagging. I don't disagree with that. But a 6-day exponential sitting there, you can see that the market is following all this up. So as it crossed right here, remember what I said, we're looking for it to cross above that level. So when we're looking at 21.8 is 21.8's pretty good. That's actually let's see, who pointed that one out? Because that's Maverick. Yeah, Maverick, I agree with you. I kind of like the 21.8 also. And one of the reasons I like it is I break it down to basically the 20 or 21 or 25 I like because it's technically how many trading days there are in the month, kind of. Because in the previous webinars, I was talking about how the fact they used to make the Japanese traders trade on Saturday too, even though there was nothing going on. They were still working. So that's why I kind of went to the 25-day. 21.8 is pretty good. It's not bad, but it's still going to lag because what's going to happen is you're looking for it to break above the area, and then you're looking for a retracement back to it. You'll notice this is why years ago I pulled Fibonacci from my charts because I realized that they had no bearing on anything. But a simple 6-day moving average would probably outperform Fibonacci on a regular basis. So, because again, that's 61.8. One coming in from JP, should we buy U.S. Canada? Well, in normal circumstances, I would suggest that that's a potential trade. But we have oil moving higher. We have gold moving higher. So if we're going to buy U.S. Canada, it's going to be after the non-farm payroll. It is not today. But if you were to do it today, let's just say you were, and I'm using that loosely, there's something else going on with this here too, that all-important 25 that I talked about. The 25 is sitting right here. Now, what I'm going to do is I'm going to say this 25 is a simple, the 6 is an exponential, the 100 is an exponential. So the exponential on 25 kind of speeds it up a little bit. You know what I mean? But sometimes the exponentials, they move a little too fast. I want to slow it down a little bit. I want to give this thing a little breathing room. That's kind of why, or another good thing is what Maverick was saying, the 8-day, I don't mind the 8-day either. The 8 days, definitely in my books for sure. And that's something you would also consider. But you can see right here, if we cross over this area, right here at 109.62, we've got a bit of a problem. But I'm going to say right now in the dailies, my downward target for that to hit is 109.21. So you're kind of in a buy zone here. I would agree. Put your stops below the lower Donchian band. I would put my stop about 108.90. That's about where I would put it. I would keep it tight. That's a reasonable trade, guys. You wanted to go long here, that's a reasonable trade. Absolutely. We look at it in the 4-hour time frame. This is not going to look pretty. Not only did it blow through my target, but, another question coming through. I'm going to take questions here in a second, too. The Donchian band is something, you guys feel free to shoot me an email, etradefx@gmail.com. You can Google search it. There's Donchian bands. Just Google Donchian bands for MetaTrader 4, and you should find one. And that's basically, because this is not an indicator that's included with the MetaTrader 4. I've put this in there, and that's what I've used in my old futures and stock tradings, and anything that applies that I'm doing here, by the way, applies to CFDs. It applies to stocks. It applies to futures, but it's incredibly effective for Forex. And again, Forex, they call it the Wild West. That's just not true. Not true at all. Currencies statistically move 1% of their value per day. Stocks move 10. This is very slow for me. Trust me. Stocks are, anybody see Wolf of Wall Street? That'll tell you what stocks are like. So, we've had a big push lower, but, again, looking at that daily, we've still got some area, we're still in the daily. We've got some pretty decent, pretty decent support. Maverick commenting on Wolf of Wall Street. It was a good movie. And that's what these traders are really like. They're sitting at their desk. Traders that are trading the news, in one hand, they've got a bottle of booze. The other hand, they got Pepto-Bismol or Kaopectate, because this is stressful stuff. Trading based on supply and demand, outside of these, we've really only got 2 major announcements during the week or during the month. We've got the non-farm payroll and the central bank announcements, FOMC, ECB, bank. Just stay away from those. And remember, focus on your trading on supply and demand. When the market starts to get illiquid, it's going to start getting illiquid on Thursday and Friday. Thursday's the new Friday. Focus your trading Monday, Tuesday, Wednesday, part of Thursday. Stay away from Friday, guys. Stay away from it, because you've got we've got the non-farm payroll tomorrow, and no real money is going to trade that announcement. They're going to trade it. They're going to try and bank profits, and they're going to shut that trade down at the end of the day, because they know what's likely coming next week. A complete reversal in the opposite direction. These central banks are trying to stabilize the market. They continually interfere with it. So we've got a couple of things in closing, we've got a couple of things to watch for tomorrow. We want to keep a real close eye on what dollar yen does between now and tomorrow at 7 a.m. Very close eye on that thing. Right now, it's again pointing towards a potential better number in non-farm payroll, despite everybody is saying it's going to be a bad number. If they revise those previous months up, remember, validation. These guys are looking for validation. It was weather-affected numbers. The U.S. is doing great. Yada, yada, yada. We've all heard it before. So we get the number. We deal with it next week. Right now, guys, what I'm going to do, if you got a few questions, yes, I'm getting the signal to wrap up. Thank you. Now, I definitely want to take the time to thank FX Street again for hosting today. They're doing a fantastic job. I watched the webinars from the other guys. all the time. Great webinars on here. Fabulous learning stuff. Take a little blend of all of us, and I'm sure you guys are going to improve. Your trading will absolutely come around to where you want it to be. And just little simple things about, avoiding and staying out of very volatile conditions, because, again, the market is constantly overshooting the market. Constantly. Then they have to go back and look at it and say, oh, geez, I think I got this wrong. When I look at the data, it's actually not what I thought it was. And then they go the other way. So this is why that kind of indecision you want to be very, very cautious of. So going to take the time to thank everybody that came out on the webinar today. Great questions. Take Maverick's advice. Watch The Wolf of Wall Street. Great movie. And once again, thanks very much for FX Street for hosting today. And I look for everybody at the next webinar at the end of the month. Thank you.